It was another sell-off day on Wall Street. No surprise, we've had a lot of those in 2022. S&P 500 was down about 0.88% today. Only about a third of the stocks managed to close in the green. But with today being June 30th, we spent a lot of extra time in tonight's video going over first half statistics and just how bad historically things have been. It was actually one of the fourth or fifth worst starts to the year in history. But the good news is we have some promising end of year results whenever things are so bad in the first half of the year. So we'll review all of that in tonight's video as well. Then we'll get into some of the macro conversations about what's going on with interest rates, some surprising developments there. We'll also talk about what's happening with commodities and of course talk about the posture across the major global markets out there before we get into our trade application example, where I wanted to feature a tech stock with a strong dividend growth history that's at an attractive level here currently, but could be at an even more attractive level if you'd be willing to sell a put on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 30th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go down below into our description area to make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. And remember, at the bottom of those emails, you'll see all the stocks giving you overbought and oversold cluster signals. When I did the video on Tuesday, there actually weren't any stocks, but today I have a suspicion that there will probably be some oversold ones, but we'll all find that out together here after a little bit. Anyway, we're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And I thought we would kind of go about things a little bit differently here tonight, with this being a somewhat important date. Today is the last day of the second quarter. Remember, we kind of jumped the gun with that conversation a little bit on Tuesday when I was talking about how rare it was to have two quarters in a row to the downside. But now we'll see a lot of the solidified and formalized statistics now that we're officially closing the door on the second quarter. And my, oh my, what a doozy it was. One of the worst quarters, or at least first half of the year, that we've seen in quite some time. So let's get into some of this stuff here on Twitter. This one comes in from Charlie Balello, and he does a great job tracking market statistics and data and things like that. And according to his records, the S&P 500 was down 20.6% in the first half of 2022, the worst start to a year for the index since 1962. This will kind of show you here in this graphic of his where we stack in the grand scheme of things. Also be aware, I saw some other statistics out there from CNBC that showed that this was the worst first half of the year since 1970. So I don't know exactly where the discrepancy is between his numbers and CNBC's, but they're right there neck and neck. You can see that on his graphic here. 1970, we were down 20.2%. This year, according to him, we were down 20.6%. So basically a tie there. So whether you call it the fourth worst start to a year in history or the fifth, it doesn't really matter. You know how bad things are right now. And, whether you go back 50 years or 60 years was the last time we saw a start to the year that was this bad, going all the way back to 1970 or perhaps 1962, depending upon the statistics. But this just kind of should solidify things in your own mind about how ugly it has been. It's been tremendously ugly, one of the worst in all-time history. Now, here's the good news. You can see he also has a follow-up here. And by the way, I retweeted this, so if you go to my timeline, you're able to read it on your own if you want outside of this video as well. But anyway, I like the fact that he also put in this next column what the returns were from the following day until the end of the year. So I guess he's looking at the first 124 days of the trading year for this first column, and then looking at basically the day number 125 until basically December 31st, and see kind of how things shook out in that regard. And you can see that in all of the cases that were worse than what we're experiencing right now, we actually did close with not gains on a year-to-date basis, but gains from that point on out. So basically, July 1st until December 31st, we did put in gains for most of those worst occurrences. Now, again, over here to this third column or fourth or whatever it is, the one all the way to the right here, you can see that the net effect of all of that was still largely down years. In other words, the second half of the year's bounce was not enough to offset the first half of the year's losses. But at least there is maybe some comfort in knowing that after these truly dramatic meltdown types of markets like we've experienced here, there's usually a bit of a bounce after that. And we might not be back to all-time highs by the end of this year. In fact, that my expectation is that we won't be, as I mentioned on Tuesday. Personally, I'm expecting us to be kind of stuck in a range for the foreseeable future and perhaps even break to new lows at some point over the next year or so. So I think it's going to be a long time in front of us before we're back to all-time highs. But even if we don't get back to all-time highs, things can at least start feeling better in the second half of the year as we head towards those midterm elections, if we are to do what has happened so often with these really first half of the years, which is basically the second half of the year does produce some snapback, kind of dead cat bounce types of rallies there. And while we're not able to get back to all-time highs and offset all of those losses, at least there could be some gains on the horizon as things kind of calm down a little bit. So good news, bad news, I guess, depending upon how you view that. So I found that to be interesting just to kind of solidify things. We're looking at basically the fourth or fifth worst start to a year in history in terms of the first half of a calendar year. Also wanted to, and by the way, congrats to David for showing up in the chart report there. I know that is a nice little honor there with some of the work that he's been doing. Of course, David's done a phenomenal job with his tweets here lately regarding his work on some of the more difficult bearish conditions throughout history. But I also wanted to look at a couple of tweets up here that I retweeted. One of them was from Lizanne Saunders over at Schwab. And she's got a graphic here similar to the one that I showed you on Tuesday when we were talking about the quarterly returns, although hers is a little bit different and is something that I don't believe it would be easy for me to pull off on the Thinkorswim platform, because what she's done here is actually combine 2 quarters into one. So let me click on this so we can see it a little bit better here and show you what she's been looking at. Notice that this kind of bar to the downside, remember when I look at it on our Thinkorswim platform, it's usually that red bar to the downside, and then the ones on the top would be the green bars. But again, her difference here is not just that she's looking at 1 quarter, like I showed you on Tuesday's presentation, but she's combining 2 quarters together here with each of these bars. So this bar here that I'm circling basically represents the first and second quarters of 2022. And you can see it was quite the ugly quarter. Stretches us all the way down to this line right here, which, as you can see off to the left, shows that that was basically a 20% drawdown for those first 2 quarters of this year. And if you were to look back at the 2-quarter combinations throughout recent history, you can see that the last time we suffered a 2-quarter drawdown like this, we'd have to go all the way back to the Great Financial Crisis, basically right there at the beginning of 2009. That 2-quarter period pushed us down 30%. But the bad news is you can see there was another bar attached right to the left of it. So you had quite the 1-2 punch there, where basically you had 4 quarters, right? If there's 2 bars and each bar represents 2 quarters, basically you're talking about 4 quarters here, or a full year's worth of time. And both of those were just atrocious. You know, one of them was down over 30% in a 6-month period, and then the 6-month period directly neighboring it was down nearly 30%. So that was, and will likely continue to be, my generation's worst case scenario situation, right? Some of you that have been, perhaps trading long enough, if you were trading back in the 70s, you also had a really ugly back-to-back hit back here in 1974. It was a few years before I was born, so I wasn't trading back then, but perhaps some of you were. And that was also a very ugly time. The 70s were a difficult time for investors. But for me and my generation, 08, 09 is kind of the benchmark. And while we are kind of down there in a more exaggerated vicinity right now with what we've just witnessed in the last 6 months, we're still nowhere near to the true ugliness that we experienced back here in 2008 and 2009. So like I mentioned to you guys in the presentation on Tuesday, brace yourself. It's entirely possible that we have difficulties in front of us for a longer period of time, right? A lot of bearish market conditions last 18 months, sometimes longer. But in the back of my mind, I usually use that 18-month time period. And so if you think that this market basically topped out at the end of last year, we're 6 months into potentially an 18-month difficult period. Now, we're going to have bounces along the way, so it won't be straight down, just like it wasn't back in 08, 09 either. But just prepare yourself to be, involved in a difficult market for the foreseeable future. It doesn't have to be easy out there, and this market is kind of proving it to us. So, like I mentioned to you on Tuesday's presentation, your job right now is to stay alive. Don't blow yourself up in the coming year or so, because you want to still have some legs underneath you when it comes time to take advantage of the eventual bull market that will emerge from a bear market, right? We know that a bear market is a rule. It's not an exception to the rule. But we also know the opposite, that bull markets are also rules. They're not exception to the rule. So the point is, things are cyclical. And after the bearish conditions eventually give way to a new bull, it is my expectation that that new bull will eventually take us to new all-time highs. Now, it might not happen for another couple of years, right? So I'm not expecting that in the short term, but I do expect that within most of our lifetimes, we will see a stock market at an all-time high again, and we want to be positioned for that opportunity. In fact, that kind of brings up a second point. Some of you saw my tweet earlier today. If you don't, I have it pulled up here in a separate tab, where I posted a snippet from my question and answer session 2 months ago. Now, Twitter it has its restraints in terms of direct video downloads, unless you kind of do more subscriber things with them. I'm not any additional subscriber beyond just the normal free user. So all I have access to is just I can post a video of 2 minutes. So that's why usually when I do these Market Outlook videos, you see my intro on Twitter, because that's under 2 minutes, but I can't actually post my whole Market Outlook video on Twitter. We have to house that or keep it posted on our website or on YouTube. But anyway, something kind of unique happened here overnight, when I learned that a company called Culp, which many of you have never heard of, announced a dividend suspension. And it was quite ironic, because I literally just got done answering a question from one of our Market Scholars clients 2 months ago in April in one of my question and answer sessions. And I was rather direct with my conversation around that company and how I was not a fan of that company at all. And I was expecting it to have a very legitimate chance of cutting its dividend. And so if you want to hear my commentary regarding that, feel free to post that there. And remember, that's part of the appeal that all of you that are premium members of Market Scholars get. Not only do you get to pick my brain when it comes to dividend stocks and long-term investing and fundamental analysis, but you get to pick David's brain as well, because he also has his own question and answer session each week when it comes to technical analysis and options inventory and short-term trading and all that kind of stuff. So anyway, if you're interested in some of the things that we talk about, feel free to watch that snippet that I posted there on Twitter, and you'll be able to find that I posted it today. So if you just go to my timeline and scroll down until you see something where I'm talking about Culp, that is it. But that is one example of how we are trying to help our clients, because even though I was harsh in my analysis, perhaps in reviewing that particular company, suggesting that I thought it was a pretty crummy company and I don't think it would be worthwhile for people to invest in, it did go down 40% since then. And it is one of the few dividend cuts that we've actually seen. Remember, dividend cuts are pretty rare, so you really have to kind of go out on a limb and stick your neck out if you're predicting that a dividend cut is likely to happen. And so this is one example where it was proven true. Now, as I mentioned to my other students today, don't put that pressure on me, because I won't be able to do that every single time. I can assure you I'm not perfect around that. But at least in this case, my spidey sense was onto something, predicting that dividend cut basically 2 months in advance and saving a lot of people a lot of pain along the way. So if you're not confident in your own evaluation skills and whether you can avoid companies that are likely to cut their dividends, and that is one of the key attributes of becoming a premium market scholar, along with so many of other excellent clients that we have here currently. Anyway, back on over here to Twitter. And I wanted to show you one final post here. This comes from Mike Sicardi. He does a great job as well. And he has a heat map here of the S&P 500, but unlike the ones that I show you guys on the Thinkorswim platform, wherever he's doing his heat map, he has the ability to do some additional customizations. And this one is basically for the entire first half of the year. So this is basically a 6-month heat map as opposed to a 1-day heat map that I usually show you guys here in these presentations. So I thought it would be kind of interesting just to get a general sense of how, good or bad things have been for stocks out there. And as you can see, it's a sea of red, and that makes sense. If we're in basically our fourth worst start to a stock market in history, then it makes sense that we're going to see tons and tons of stocks down significantly. And as you can see, the vast majority of companies in the S&P 500 are down on a year-to-date basis. And remember, that's actually somewhat rare. Usually, if you just take any random 6-month period throughout history and post a heat map of the S&P 500, the vast majority of those instances throughout history, you'll have more green boxes than red boxes. That's the nature of markets generally going higher. So that again kind of solidifies that we are in a somewhat more unique moment in time here in the markets. And look at some of these just awful, awful returns out there. There's Apple down 23%. Of course, talked about Apple with our bearish trade on Tuesday. There's Microsoft down 23%. So both of those are basically your most important companies to the S&P 500 because they are the largest market cap, and therefore they have the biggest impact on a market cap weighted index like the S&P 500. Both of them are basically in their own, quote unquote bear market, if you kind of use the 20% from its highs vernacular there. But that wasn't even as bad as it got. Take a look at their pals over in the social media world, Meta/Facebook. The name change didn't really help the circumstances because Meta/Facebook has literally lost half of its net worth just this calendar year. Just in 6 months, half of the value of the world's largest social media network has just evaporated into thin air. Alphabet/Google didn't fare that much better. They were down 24%, so worse than Microsoft and Apple. Amazon has had a terrible first half of the year, as has Tesla. Remember, those two are in the consumer discretionary space, each down more than a third. So not nearly as bad as Facebook, but still basically 1/3 of the value of Amazon has disappeared this calendar year, and 1/3 of the value of Tesla has disappeared this calendar year. You can see lots of other pretty aggressive movers. Some of the financials I think have gotten quite cheap. JP Morgan has lost not quite a third of its value this year, but approaching that level, being down about 29% in this last 6 months here. And some of the numbers get even worse. Like if you were to look at PayPal, it's down 63% this year. Nvidia is down 48% this year. And there's others as well, but they're smaller and maybe less important in the grand scheme of things. But that should give you at least a feel and a flavor for how difficult it has been this year. when it comes to who have been the winners this year, well, from a sector perspective, it's really just been one or two. Of course, energy finds that it has the most concentrated amount of winners on a year-to-date basis. Of course, companies like Exxon up 40%, so a very strong year-to-date performance despite very healthy givebacks in the oil patch here in the last 2 or 3 weeks. Behind them, I would say that utilities deserves a conversation. While it's not quite as consistent, and you do have plenty of red in the utilities as well, you do have about a 50-50 split there, I would say, in terms of utilities that managed to close in the green on this 6-month basis. And I would probably throw consumer staples into that conversation as well, where you have a nice smattering of green in those consumer staples. But the problem there is the bigger consumer staples like Procter and Walmart and Costco are all in the red. So from a market cap weighted perspective, they still struggled. But there are a number of, as you can see, green patches here in that consumer staples area. You also had healthcare hang in there reasonably well, depending upon circumstances. The big pharmaceutical areas seem to be your winners, your Eli Lilly's and AbbVie's and Merck's and Bristol Myers and Johnson & Johnson. They managed to close in the green, along with some of your health insurance companies like United Healthcare. And then you had a smattering of kind of niche areas. I would call the aerospace and defense a bit of a niche area that benefited, not because they were doing anything special, other than it just so happened that this big market downfall happened at a time when the world got a bit more violent, of course, with Russia-Ukraine war raging on. Those defense contractors like Raytheon, Lockheed Martin, General Dynamics, Northrop Grumman, and L3 Harris, those types of companies benefited as a result of that unique circumstance. And then you did have a few of the telecoms, closing in the green there as well. But as you can see, most of these areas, by the way, special shout out to the insurance companies as well. While most of the financial areas got smoked during the first 6 months, some of your insurance companies actually managed to close in the green there. So you can see it was quite sporadic outside of energy in terms of any area that you would have been able to kind of hide out in. What I can say is that many of the areas that did close in the green are well known to dividend investors as big blue chip types of companies. Many of them are actually even dividend aristocrats. So I noticed that like Chubb, an insurance company, is a dividend aristocrat that closed in the green. Johnson & Johnson, of course, is a dividend aristocrat that closed in the green. IBM, believe it or not, with all this death and despair and technology around it, IBM kind of stands in there like taking it like a champ. Now you also have to remember IBM struggled mightily in recent years when the rest of the tech stocks were taken off to the upside. So now you're kind of seeing the reverse of that. But IBM is a dividend aristocrat. AbbVie is a dividend aristocrat. Exxon and Chevron are both dividend aristocrats. Con Ed is a dividend aristocrat. Coca-Cola is a dividend aristocrat. Archer Daniels Midland is a dividend aristocrat. So there's Cisco Foods, that's the distribution company, that's a dividend aristocrat. So I can at least say that a number of dividend growth stocks that we tend to focus on in my dividend growth investing class did manage to survive this storm a little bit better than a lot of these other areas that were focused almost purely on growth. Those areas struggled the most this year. All right, so let's now pop on over here. Oh, actually, before we go back to the Thinkorswim platform, since we're on the internet, let's just take care of this as well. I always like to say thank you to those of you that help support these market outlook presentations. As I always say, as long as we get at least 100 people that these videos are benefiting out there, then we're happy to take the 3 hours out of our day to put these free videos together for you. And so the last time I did the video on Tuesday, 112 of you stepped up to the plate and said, "Thank you, Brandon. I appreciate those 3 hours. I think I learned something from you during that presentation." Remember, we don't require you to pay us any money or anything along those lines. All we ask out of you is just simply support the presentation by clicking like for us there on Twitter. And I'll make the same deal for you I always do, which is when I'm scheduled to do this video again on Tuesday after the 4th of July holiday, as long as we're up and over 100 likes on the current video, I will plan on doing a full-length video featuring featuring lots of different charts and analysis and an actual trade application example. If we're under 100 likes, then we'll just stay with a very small 15-minute version of the video, only looking at the 4 indices without all the extra charts and stuff. So I'll let you guys kind of decide in the end. Do you like these longer form videos with additional commentary and things that are catching our eye, like I've discussed already in tonight's video? If so, click like. If you don't like that and you just want us to only look at just a couple of charts and then move on with your day, that's all right as well. Don't click like there, and we'll try to figure out what you guys desire between those two possible choices. Also, while we're over here, a reminder that David will be teaching his technical analysis class tomorrow. He'll be in the process of building out our class calendar here tonight, I'm sure, because we have to build those calendars out 1 month at a time. So for those of you that are still waiting to register for those classes who are premium members, I'm sure he'll send out the email like he always does, so keep your eye on your email there. But tomorrow does represent July 1st, so he's got to get that built out. And then, of course, next week we'll be back and up and running after the 4th of July holiday with the markets closed on Monday. We'll be back in action on Tuesday with my dividend growth investing class. Earlier today, David taught his portfolio management with ETFs class, and I taught my question and answer session, which has already been posted. It was about a 3.5-hour class, and the types of things that we discussed were things like real-time data technology. So for those of you that are thinkorswim users, you might not be aware that you can connect the thinkorswim platform to an Excel spreadsheet in order to get real-time data basically flowing directly into your Excel spreadsheet, which makes your life a lot easier depending upon your Excel projects that you might be working with within the stock market. So that was one question that I got. I also got a question about, what percentage of a lump sum payment would I put into dividend growth investing portfolio versus options for long-term investors and other strategies. So I had a conversation about that. I had a conversation about looking at Trinity as a dividend growth investment candidate. I had a question about looking at CAS information systems as a DGI candidate. I got a question about how to interpret the colors in the cells for the tickers on the stock selector tool, and I got a question about what my thoughts are currently on European stocks and ETFs out there. So if any of that sounds interesting to you and you're a premium member of Market Scholars, feel free to check out my recording and fast forward to whatever question you have an interest in hearing my answer to. Lastly, let's take a look here at the factor selector. And as you can see on the top, we didn't have any change week over week. Low volatility remained at the top, and that makes sense when we're in a very difficult market like we're in right now. Areas like utilities and consumer staples, major pharmaceutical companies, those companies that are oftentimes the least volatile, come from the most boring industries, and that is where you can kind of hide out when the market gets a little bit chaotic. So we are seeing that right now. We'll talk about treasuries here in a little bit as well, but another thing that I've noticed here in just the last couple of days is we had quite the pullback in the 10-year treasury yield. And remember, that can sometimes positively benefit low volatility factor as well, because you do have so many utilities in there. Utilities are very interest rate sensitive. And if we start seeing interest rates pulling in a little bit, that could then further benefit the values of utility companies. So, be aware of that possibility. I'm not saying that's going to continue to happen, but it is something that is a possibility out there for those of you that weren't aware of that interest rate sensitivity to that particular factor. On the downside of the factor selector this week, we did have quality back in the final position there. Now remember, quality was there for 2 weeks in a row about 3 or 4 weeks ago, and then it kind of gave up that final position for 1 week and now is right back down there. Some of you might be surprised to learn that quality ETFs in this current era are chocked full of technology companies. And from my perspective, that's the big reason why quality is suffering here in this exact moment in time, because this is a market that is trying to stay away from growth-oriented areas and more speculative areas. And it just so happens a lot of those software companies like Microsoft would represent the quality ETFs these days. So I think they are kind of getting punished as a result of their above average allocation to the tech sector compared to the way that quality ETFs would have been structured in years and decades in the past. All right, let's come on over here to the Thinkorswim platform now, and let's take a look at our heat map for a one-day basis. Remember what I showed you there on Twitter a while back was for the full 6 months. Now what we're looking at here is the more traditional view on Thinkorswim, where it is showing us what happened just today alone. And so as you can see, probably a lot more red on our screen in front of us than green, although it wasn't a complete wipeout here today. So it could have been worse, I suppose. We can all take comfort in that. Some of our bigger players were down. Apple was down nearly 2% today. Remember, that's a good thing for the trade that I placed on Tuesday's video, where we did a bear call spread there. We'll see how that one works out. But in this particular case, I was happy to see Apple down. It's a fine company, of course. Some of you saw me on Twitter last night posting a picture of my iPhone from back in 2007, saying that, hey, if the Smithsonian wants to come and knock in, I still got it, because it just so happens that yesterday was Apple's 15-year anniversary of their iPhone, and of course all the iterations since then. So Apple is just a wonderful, fantastic company and business, but doesn't mean that fantastic companies and businesses have to see their stock price go up every single day or every single week or every single month. And so, you know, there are times where you can place bearish trades on companies that you very much admire. So Apple was down about 2% here today. Microsoft was down just over 1%. Salesforce was down 3%. Remember, a lot of people forget Salesforce is actually in the Dow Jones Industrial Average these days, so it was down 3%. We had Nvidia down 2.5%. We had Alphabet down 2.5%. We had MasterCard down 2%. JP Morgan was down 2.3%. Bank of America down 2.3%. So these banks, kind of interesting, they got blitzed here again today. And remember, just earlier this week, some of them were reporting some pretty healthy dividend increase announcements. At least Wells Fargo and Bank of America did. JP Morgan and Citigroup actually held their dividends steady. But they were down yet again today. Not only the banks, but the investment banks. You know, Morgan Stanley was down nearly 3%. Goldman Sachs was down over 2%. So both of those announced very big dividend increases here a couple of days ago as well. So I tend to think there's some value in the financial space for those of you that want to be longer term oriented investors. But in the short term, as traders, you probably better be a little bit cautious in that area, because a lot of the trends are, of course, negative and more bearish in that particular sector. You saw that Amazon had a tough day, down 2.5%. Tesla was down nearly 2%. We also did see that the energy sector got hit pretty hard today. I don't see a single energy stock in the green, at least in the S&P 500 here. All of them were down. And so one of those days where energy couldn't bail out the market like happened so often in the first half of 2022. In terms of areas that did manage to close a little bit more in the green, I would say utilities catches my eye from that perspective. Down below here, it looks like we have quite a consistent green color in that utility sector. Maybe a handful of them, like Sempra, was down 0.03%, so call that break even. But otherwise, we had some decent winners there. You know, NextEra was up about 2%. Exelon was up over 2%. Southern Company was up about 1%. So the utilities seemed like it was an area where you could have avoided today's sell-off. You also found a lot of those defense contracting companies that I'd mentioned before: Raytheon, Lockheed Martin, General Dynamics, L3 Harris, Northrop Grumman. They were all up here today. So perhaps continued flare up there in Russia, Ukraine, but that's been one of the areas that you've been able to kind of hide out in. And, you might have got lucky just because of how things shook out regarding the geopolitical skirmish there. Remember, had that not been happening in Russia, Ukraine, it would be highly likely that those defense contractors would also be down with the rest of the market this 6-month period. But they happen to be an area where you you would have been able to hang out. And the good news is a lot of those are good dividend paying companies as well. We did have some healthcare companies that managed to close in the green today. Johnson & Johnson closed up, Pfizer closed higher, Thermo Fisher closed higher. We had Anthem closing higher and a handful of others there. Real quick, there's a couple of really bright green spots up here from Enphase and then also Solar Edge. Those are technically part of the semiconductor area of the market, but they are both semiconductors specifically for solar energy. And so that seemed to be a little mini niche theme that worked really quite well here today. Did have a handful of consumer staples that were up as well, like Procter & Gamble and Costco. So it's a little bit more of a mixed bag here today, but on the whole, as you can see, it was quite apropos that we end this horrible 6-month experience that we've all been living through with yet another sell-off day in the market. In terms of market breadth, let's go ahead and check that part of the Thinkorswim platform. Up here on the Market Watch Visualize area, I've pulled up the S&P 500, and you can see that we had about 158 companies close in the green here today, whereas 345 companies closed in the red. So, about a third to two-thirds split there, with a third of them closing in the green and two-thirds in the red approximately. So it wasn't an overwhelming bearish day. There were moments during the day where it was a bit more touch and go. As we come on over here now to the charts, you can see that the S&P 500 closed down 0.88% today, but there were a couple of different times on an intraday basis where the S&P 500 was actually down more than 1%. So had a little bit of a bounce there at the end of the day to avoid that fate. But you can kind of get a sense by looking at the candle here. Let me right click and maximize this cell so that way you can see what this candle today looked like. You can see that's quite the nice little doji candlestick right there, where you basically closed today where you opened, where you had quite a bit of range to the upside. You also had quite a bit of range to the downside, but in the end you basically closed exactly where we gapped down to start the day, right? This was still a down day, but we gapped down to start the day. So the open and the close appear to be very, very close in today's candle there. Now, when we're looking at this, notice that we have something new to report for you here tonight in terms of our posture using the market forecast technical indicator. We are now with a bearish posture. Remember, I hinted towards that when I was with you here the last time around, saying that if we get a couple more down days, it's likely we would go immediately back to strongly bearish posture, pointing out how the intermediate line was not yet above the 50th percentile when I was with you here on this candle, saying that if we do, which we can see happen 2 days later, it wouldn't go to a weakly bearish posture, it would immediately go to a strongly bearish posture, and that's exactly where we're at right now. And so, I'll say the same thing that I mentioned on Tuesday, which is this is still not a healthy looking chart, right? There are some people that truly think that was the low in this move. Now, after 4 days of selling, they probably, quieted down in that conversation a little bit as well. But there were some people that felt like that was it. Okay, we went down significantly. We took 20% off the top of the S&P 500, and now the markets can go up again, and we're going to be, back to all-time highs, and it's going to be puppy dogs and rainbows and all these other good things, right? But no, that's not it's not how markets work. If that's your mindset, then that's probably because the only pullback you've ever experienced was during COVID, when that actually did happen, but that was the rarity. The other side of it is not the rarity. Most market pullbacks throughout history do not just immediately reverse and you're done with it. Most of them you have to kind of earn your keep, and it usually is a function of both price and time. And we still have a long ways to go from a time perspective, at least if you were to compare it to other bearish moments in history. And so just brace yourself there. But, as I look at these charts, what I see is still a continued path of least resistance to the downside, which is why I said don't get too ambitious with the fact that we had a weekly bullish posture over here. We were still below a falling 30-day moving average during that entire move. So, you have to use both of them in conjunction with one another. Path of least resistance continues to be the downside. And I'm willing to change my mind around that point, but what I need to see in order to do that is for us to consistently stay and trade above the moving average. And what the market is proving to me right now is that it doesn't particularly want to do that, right? You had a couple of attempts in the last couple of months, and in each bounce back, it just proved to be very short-lived, where you were better off selling the rips, right? We've had that conversation a number of times this year as well, where, you know, in previous years, it was a buy the dips type of a market environment, where every time the market came down, you better jump on that gravy train, because otherwise you might miss your opportunity. Well, that train is done. It's now turned around. It's going the opposite direction. And now we're in the mindset of selling the rips. You know, if you got caught holding too many stocks or you have too many bullish deltas, then one way to tackle that conundrum is by slowly getting out of those bullish deltas when you have those momentary opportunities, when we have those snapback rallies along the way. So anyway, I don't think any of you should be surprised that we are back to strongly bearish postures, since I just had this conversation with you on Tuesday in anticipation of this. So strongly bearish postures on the S&P 500, the NASDAQ Composite, and the Russell 2000. The only holdout there is the Dow Jones Industrial Average. It's still managing to cling to a weekly bullish posture, but judging by what we see right now, I don't know how much longer that's going to last, right? Remember that the Dow Jones traditionally moves more slowly, both on the upside and the downside, than these other three indices. And so I think it's more of a function of the Dow just having the benefit of the doubt with more blue chip companies that don't sell off quite as violently as the major growth stocks out there. So I think it's just a little bit of a delayed reaction, and there's a strong likelihood that Dow Jones Industrial Average, either tomorrow or early next week, will follow these other three with a strongly bearish posture once again. You'll notice here that just like I had mentioned on Tuesday, it continues to be the case that all of them are below falling 30-day moving averages. So remember, that's not new information. It was new on Tuesday because on that day we had transitioned from a yellow moving average to red on the NASDAQ and here on the Russell 2000. But in the 2 days since then, of course, we've had sell-off days in the last 2 days, so it makes sense that it continues to be price below falling moving average, which is a bearish feature. It's not something that you view if you want the markets to be bullish. In terms of the actual results today, I always like to at least verbalize those because I know it's really hard to read the percentage returns that are listed in gray font here on the Thinkorswim platform, especially if you're watching this YouTube video on your phone right now. So just to put a bow on it, I had mentioned already the S&P 500 was down 0.88%. The Dow Jones was down 0.82%. The NASDAQ Composite was the worst performer today, down 1.33%, and then the Russell 2000 was down 0.66%, which was actually the best performer of the day, believe it or not. Still down pretty significantly, but just down less than the other large cap indices that are out there. Let's go ahead and do some 12 grid analysis now. And I'm going to pop on over here to our chart 5A, our asset class 12 grid. And as you can see, there's a mixed bag in terms of, green charts versus pink charts. And remember, that is very normal. It is set up that way on this first set of 12 grids because the asset classes cover such a wide variety of financial products that there's almost always going to be some that are bullish and some that are bearish. Whereas when we go into our next 12 grid looking at sectors, all of those are stocks, and therefore there's plenty of times where there's a clean sweep either up or down on the stocks. But here on this asset class, we have things like interest rates, and then we also have in the opposite corner bonds, and usually those two things are inversely related to one another. So should not be a surprise here when we see that in the lower right-hand corner, we see the 10-year U.S. Treasury yield now with a weekly bearish posture, whereas the inverse of that, when we look at the TLT off to the left-hand side here in the middle rung, now has a weekly bullish posture. In fact, don't look now, but take a look here at TLT with your green moving average. I mean, it's literally been months since I've been able to say that, right? And we've talked about this idea here pretty consistently in the last 2 or 3 weeks, and I hope you guys appreciate that because, again, we kind of have to stick our neck out on the line when we talk about things like this. But, when I brought up the conversation about Tina versus Tara, right? You guys will remember that conversation with you because it happened immediately after a question and answer session with my premium members where we were having the exact same conversation. So it was likely a Thursday, whether it was 2 weeks ago or 3 weeks ago, I can't remember. But some of you will remember the acronyms I was using with you called Tina and Tara. And Tina was, there is no alternative, and talking about how in recent years you almost had to go into the stock market because only a fool would go into the bond market with interest rates as low as they were. If you needed income, there was no alternative. You almost had to go into the stock market. And then bringing up the converse of that of Tara. Now there are reasonable alternatives. And you can see that ever since then, we've actually had a decent little rally here on TLT. Now, how long it's going to last, I have no idea. What we do know is that the interest rate environment got to historical lows, about 6-7 months ago or whenever it was. And now we are in that snapback of interest rates, which usually means bond prices struggle. But we might have finally reached a level where there are participants out there that want to start buying bonds for income again. Remember, you could actually buy a bond and get about 3% or in recent weeks higher than 3% yields, which in the past you were having to suffer with less than 1% yields on a 10-year Treasury. So I'm kind of curious for myself. Let's maximize this TLT chart and see when was the last time we had a green 30-day moving average. And for those of you that aren't as familiar with this video, basically what that means is price is above a rising moving average. And as you can see here, in the last 3 months, that has not happened until today. So that's kind of a big deal there. But let's go back a little bit further from more than 3 months back, and let's go to 6 months. And here you can see we haven't had it all year, right? A 6-month look back chart right now, because today is the final day of the 6 months, is it basically also a year-to-date chart. So I can tell you that year-to-date today represents the first time the entire calendar year that TLT has had a green moving average with price above a rising moving average. That's really saying something. This has been basically a one-way train lower on bond prices. That is slowly starting to attempt to change. Whether it actually does change, we have to wait a little bit of time to figure that out. But we do know for certain there's a legitimate attempt taking place right here. Let's go back a little bit further on a 1-year, 1-day basis. And here we can see that the last time we had a green line on TLT was back here in December. So it's been basically 7 months since we've had what is now appearing on TLT. So it's another way of saying there's been enough value destruction in the bond market where inversely bond yields are going higher when bond prices are going down, that they're actually more reasonably attractive down here than they would have been back late last year. So keep your eye on that theme. It has a possibility of having an impact. Even if you don't trade bonds yourself, it can have a pretty big impact even on various areas of the stock market. As I mentioned before, utilities is just one example, are pretty interest rate sensitive. And so interest rates, as you can see, are now trading below their moving average. So the moving average here on TNX is yellow because the moving average itself is just barely still going up, but price is now below it. But that moving average is starting to flatten out, and it's possible we end up with a red moving average on TNX. Now, it wouldn't be as dramatic as what I just showed you on TLT in the opposite direction, because here we have had a couple of instances in the last 3 months of that red moving average. But nonetheless, it is a reminder, or at least worthy of a conversation, of whether interest rates maybe spiked too far, right? We were talking about how during that 6-month period, interest rates basically had one of their biggest 6-month spikes in history. And so, at some point you push a concept a little bit too far and too fast, and maybe that's where we're at right now with interest rates. So in this particular case, you can see if you move the decimal over to the left one on TNX, we ended the quarter at 2.97%. And as I mentioned in my question and answer session today, that pleases me because that has been one of my difficulties in the dividend growth investing class, is finding stocks that have more attractive yields than government bonds right now, whereas that used to not be an issue. But right now, there are two stocks specifically that I brought up in my question and answer class today, and that I've talked about quite a bit in the last 3 weeks or so, that I've been itching to bring to my DGI class's attention, but I haven't been able to. But now with the TNX pulling back, if it stays at these levels or lower come Tuesday morning, there's a good chance that I'll be talking about one of those two companies. I won't spoil the surprise, but some of you know who I'm talking about there nonetheless. So it's opening up perhaps a few more doors in other areas, even though interest rates from the bond market are getting a little bit less attractive than they were a week ago. They're becoming more attractive perhaps in some individual stocks in the market. You can see that the US dollar is retaining its strongly bullish posture. It's the only dark green chart that we have on the board here out of these 12 particular charts. And it is above a rising 30-day moving average. The dollar remains strong. Remember, that's a pretty consistent theme throughout chaotic markets in history. The dollar is kind of viewed as the best house in a bad neighborhood, right? Central banks around the world are usually quite questionable in their nature, and a lot of times when money is trying to seek safety, it views the U.S. currency as one where at least it can kind of retain its value a little bit better than other areas of the world where you just don't know when the government will be upended or something along those lines. And so I think the dollar is kind of benefiting from a little bit more of a safe haven type of a mindset at this exact moment in time. Now, when the dollar is strong, sometimes that can mean that commodities are weak, and we're definitely seeing that out of gold. Gold was down again today, remains with a strongly bearish posture, and just does not look like it wants to get out of its rut. In fact, it looks like it wants to start pointing down and perhaps might even start breaking to new lows here within the short term. Oil had been able to kind of withstand the rising dollar environment and was continuing to go up regardless. But that has even started to call into question here in the last few weeks. We had this really nasty downswing in oil. Of course, we talked about that a week ago, and we spent all that time on the 12 grid for the commodities. But even in the last 2 days, it's been pretty ugly for oil and correspondingly the oil stocks themselves. And notice that oil now has its own red moving average. So not only does oil have a strongly bearish intermediate posture, but we are now below a falling 30-day moving average there as well. And again, that is pretty rare. There's just a handful of times throughout the last 3 months where that has occurred. In terms of other areas, notice that foreign bonds like the U.S. Treasuries did benefit today. However, the high yield bonds, junk bonds, suffered today. Now, not dramatically, but it's saying something when junk bonds were down and other bond categories were up. It's basically saying that the riskiest elements of the various financial markets out there are being sold off right now. And this continues to be a risk-off environment that we find ourselves in. You'll notice on the top rung, we do have a few light green charts kind of starting to pretty the picture up a little bit. However, I wouldn't make too much of it yet. Yes, the postures did revert back to weekly bullish on foreign stocks and even preferred stocks. But as I look at all three of those charts up there in the light green, all three of them still have red moving averages. And so it's the same thing like I mentioned to you guys on Tuesday with the United States markets. I'm not going to get overly excited about the prospects of a big bullish move out of those areas until I see them trading above their moving averages for a more consistent period of time. And they just haven't proven their willingness or desire to pull that off here. And so you kind of have to keep a tighter leash on situations like that when we're in these more chaotic risk-off types of market environments. So the good news is you're starting to see maybe some small green shoots, but it's still too early to determine whether those seeds that you've planted will turn into healthy crops or not. It's a big question mark out there, so stay tuned. We'll find that out as the summer progresses. Let's now take a look here at our, and by the way, I should mention Bitcoin. Bitcoin got smashed today. Some of you saw me tweeting about it last night with the big news that the SEC rejected what's the company's name? Grayscale's fund. I think it's an exchange traded fund where they were hoping to convert it into a spot Bitcoin ETF. And this has been something that they've been trying to do for a long, long time now. And that grayscale fund trades at a tremendous discount to the Bitcoin that it holds. And a lot of people were buying it with the hope that the SEC would greenlight its conversion into an ETF, and thus you could see a bit of an arbitrage situation there where all of a sudden that discount would be tightened up at a minimum, or perhaps even go into a premium. Well, that didn't happen, and so as I predicted last night on Twitter, it's probably going to be an ugly day for that particular fund. GBTC is the ticker symbol, and indeed it was. That was down 9% today, and Bitcoin itself also struggled and is down below 19,000. So again, another way to test the risk appetite of the current market is what's going on with cryptocurrencies. And cryptocurrencies continue to get smashed here on days when growth stocks also suffer. So not a surprise there if you've been listening to these videos over time. Let's go ahead and take a look at our sectors now. And looking at chart 5C, will give us a sense of how things are shaking out here from a market cap weighted perspective. And as you can see, it's a bit of a mixed bag depending upon the areas of the market. But what I would say is none of these charts really look good to me. Now, it doesn't mean that we can't, work on the charts and see, more, positive and constructive behavior moving forward. But it just means that if you're looking to play the trends, I mean, let's be honest with ourselves. Let's look at these charts. Do these look like healthy charts? To me, they don't. There's a few little minor bullish elements here or there that you could kind of point at. But in general, these are some pretty sick, ugly looking charts out there. I would say that the one that is the least sick happens to be healthcare. Pardon the pun there, right? The least sick is the healthcare sector. It seems to be kind of stabilizing at a greater rate more recently than a lot of these other areas. It is the one with the dark green background color. So we do have a strongly bullish posture on healthcare, but I still wouldn't even get carried away with that. It still doesn't look like a good trend. And so it's the one that stands the best chance of becoming a good trend in the future, as long as we don't have a continued sell-off in the market. But that does not mean that now currently it represents a good trend. So anyway, it's ugly out there, regardless of what you're seeing from a posture perspective. But to be fair, financials, industrials, staples, and utilities do have weekly bullish postures. But again, those charts do not look all that healthy in my perspective. And where we did have one chart out of the 11 sectors that looked healthy for most of this year, energy, now it no longer looks healthy either. So, again, back to my presentation that I gave you guys a week ago, when we spent that time looking at all the commodities like, sugar and cocoa and corn and wheat and silver and palladium and, oil and natural gas. The whole point of me spending as much time on that video on that was to tell you my mindset is changing on commodities right here and right now, because it was a violent blow that had been suffered by the commodities, which was different than the normal, gradual pullbacks that we had previous to that. So prepare yourself for the possibility of, energy not being able to hold up alongside any of the other areas that are trying to hold up in the second half of the year. That can change. Of course, energy is very subject to geopolitical winds, and so if war continues to rage on in Russia, Ukraine, or perhaps moves to the Middle East or something along those lines, that changes the aspect there. But in general, I do think that this was a violent enough pullback in energy recently where you've kind of got to reevaluate those trends that you might have been in previous to that moment in time. Let's go ahead and get into our trade application example idea now. And many of you know that on big sell-off days, I am more likely than not to bring a sold put idea to your attention. Tuesday was a little bit of a difference from that. Some of you probably expected me to bring you a sold put idea on Tuesday, but I just couldn't resist doing a bearish trade on Apple or really any other. As I mentioned, I wasn't trying to pick on Apple. I basically used it as a proxy because it was very liquid, but basically the whole stock market looked like it was bouncing down and away from a falling moving average, so I could have really picked any company. So I reserved my ability to sell a put for today instead of doing it on Tuesday, and remember, all else being equal, that is a wise decision because you're going to get better opportunities if the market continues to fall if you held off on doing sold puts previous to that. So the stock that I chose here today was Corning. And we sold the $25 August puts, and we targeted the 1% return on risk, so we were able to get filled at 25 cents. And I think that gives us a nice amount of flexibility in this chart. You can see just a couple of weeks ago we were dealing with oversold weekly clusters with that little green dot there. You can see that we're already trading in the blue zone of the dividend stair-step chart, meaning that its current yield is already attractive compared to its historical standards. And naturally, if the stock were to fall from a current $31 where it's yielding 3.4% and you were forced to take ownership of it down here where you sold your strike at 25, its dividend yield would be over 4% at that level. And for some companies, a 4% dividend yield is perfectly normal. For Corning, it is not. Corning is the company that many of you perhaps know these days as being the company behind Gorilla Glass, the company that has basically the glass on front of all those iPhones and other smartphone devices that are out there, but of course has a big business in fiber optics, and it's even in the biotech labs, and it's in environmental areas for engines. So they kind of have a sprawling business, but it is a company that is kind of attached to the technology sector and is one that rarely comes with above average dividend yields of 4% plus. So that was the trade idea here in this case. I think it's getting reasonably cheap. Be aware you will have to hold this through an earnings announcement, so make sure that if you do this type of a trade, you actually are okay with the prospect of being put the stock at $25. But given the landscape around me, I think that's a pretty acceptable trade-off. I doubt it's going to get down to 25 by August, and if it does, I think this is a reasonably good company to take ownership of at that particular dividend yield. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. If you did, I ask one simple request out of you, and it doesn't cost you a cent. It just costs 5 seconds out of your day. Go over and click like for me there on Twitter. If we're up and over 100 likes, by the time I'm scheduled to do the video again on Tuesday, I'll plan on doing another full-length video there for you. If we're under 100 likes, then I'll just do a quick little 15-minute hitter just on the indices themselves. Also, with this being an upcoming holiday weekend for us here in the United States, I hope you all have a safe and fun, enjoyable weekend. Unplug from these awful stock markets for a while. Maybe throw some ribs on the grill, enjoy a slice of watermelon, have some family time there, and then come back refreshed, ready to tackle the markets next week as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.